Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today, we're stress testing and challenging some narratives in the energy world. Will we still see peak oil in the 2030s? Is there underinvestment in oil production that could lead to energy shocks? And is the energy transition dead, alive, or somewhere in between? Our guest is Jarand Rystad, CEO and founder of Rystad Energy, the independent research and energy intelligence company providing clients with data, insights, and education that better empowers decision-making. As always, you can really support the show by leaving us a positive review on the platform you're listening on. And as always, I hope you enjoy the episode. Jarand, welcome to the show.
Thank you. Great to be here.
So we've sort of designed this as challenging narratives in energy, and obviously you're perfectly placed to do that given your global scope and understanding. Let's start at kind of one of the big ones, which is, if I cast my mind back a couple of years ago, we had the IEA saying peak oil in 2030, and people were plus or minus that. How has that narrative shifted as we've driven more back to energy security? The energy transition has had its challenges in financing costs and in policy and so forth. Where do we stand on peak oil? And I know that's a big question to start off with, but we might as well jump right in.
Yeah. No, I still think that early 2030s is a likely point in time for the peak oil. I think we are now going into a kind of plateau phase where it will be driven by aviation and the petrochemicals. It will still be a net growth, I believe, for the next 5 years, about 1 million barrels or slightly less per year. But China, as the key driver of demand growth, is definitively over. China is already having had peak diesel, probably at peak gasoline as we speak, but still with some growth in naphtha, petrochemical feedstock. And China has been the most important market, but for oil demand growth, that will not go on. And Europe and United States has already been peaking and declining for quite some years, but still now, of course, it's the rest of the world that is driving oil demand growth. So, but the sum of all of these geographies will be a plateauing of global oil demand in the early 2030s. And a little bit depending on the economical cycles, it could be several peaks. It could be a few years, it could be declining, and then it could start to grow a little bit and then declining again before the structural shift comes in stronger and stronger towards the end of the 2030s.
There's a lot to unpack there. My first question would be, okay, so driven by aviation and chemicals, that growth that we will see up to 2030 there or thereabouts, how does that change the demands for the barrel itself? Does that sort of prefer certain types of lighter crudes than others and so forth? And then I want to talk a bit about, we're plateauing. What does that plateau look like? It is a long one? Is it a short one? What would accelerate or decelerate that?
Yes. So let me start with the demand side then first. And aviation, it peaked at 7 million barrels per day in 2019 before COVID. And then it went all the way down to 3.5 million barrels per day, so basically halved. And now it's just back up where it used to be in 2019. So, of course, this is, since the global economy has been growing quite much, it's a structural shift away from business travel a little bit. But we still expect some of that to recover, and that we will see a peak aviation at around 8.8 or maybe closer to 9 million barrels per day in the mid to late 2030s. Yeah, so this is the total jet fuel demand that we see.
Just jumping in on that, obviously the hardest to abate in terms of hydrocarbons is aviation, right? You've got decades to get a new engine to market.
Yes.
And why would there be a peak in aviation, to put it simply, in a world that's, unless things go pretty dire, why would we see a peak there? Or is this factoring in greater efficiency in engines? Is this factoring in a technological change?
It is, but that is not driving the peak. I think the peak will be because you will have more sustainable aviation fuel coming in. So, meaning bio-based jet fuel, and longer term e-fuel, and also the combination of biofuel and e-fuel in aviation. And we see a lot of progress has happened only over the last 2 years, and they're starting now to blend in sustainable aviation fuel. You even had a flight quite recently that was 100% SAF crossing the Atlantic with a lot of celebrities on board. So that was a quite fun flight. I just spoke to the pilot actually, and he said that it went very well, even if they were not allowed to use more than 50% on each of the engines. But it's working, but it's more expensive. So you could say in general, green molecules are 2 to 3 times more expensive than brown molecules. So of course, green molecules need some kind of subsidies or policy support to get into the market. But on the other hand, green electrons are in many places half the price of brown electrons. So of course, green electrons are very competitive, and eventually these green electrons can be turned into also green molecules at a lower price. But this is where we see that e-fuel will take over from bio-based fuel, which is more the scope we see for the 2040s and 50s and onwards.
Yeah, yeah. And what, staying on that demand side, what about the chemicals piece? Are we seeing any transitions there? And indeed, as you move to more of a chemicals demand over time, or greater slice of the barrel, what implications does that have for the barrel itself?
Yes. So long term, towards the end of the century, we see a need for approximately 25 million barrels per day for non-energy purposes, but that could be fossil fuel. This is for the production of plastics, but also asphalt, lubricants, roof cover, other products that are based on these molecules. And these molecules could then be both fossil fuel molecules, or it could be bio-based molecules. And since most of these molecules are not then combusted, but they are into lasting applications, it's not a big climate problem to produce this. So long term, even 100 years from now, I think we will have quite some fossil fuel production because it's competitive molecules. But a whole large share of those 25 million barrels per day that will be green versus brown depends on, of course, economics towards the second part of this century. But as I said, it's not a climate problem, even if they are based on fossil fuel. But this is going to grow towards 2050 and then flatten out according to our long-term estimates on consumption from the purpose of building materials.
So once you're still sort of this 2030 date, roughly speaking, do we then have a long period of plateau, or do we see a sharp decline? And I guess what might accelerate or decelerate that decline?
It will be a period of a plateau that will last for maybe 5 to 10 years, from the late 2020s to the late 2030s. And then it will be quite a quick decline as all the fleets that are consuming molecules then will start to get a net growth that is, almost all the new entry to the fleet of personal vehicles or trucks or buses, etc., will then be based on other energy than fossil fuel. And so then you really start to see a very rapid decline. We have seen that, for example, just now I'm sitting in the middle of Oslo today. fuel consumption in Oslo has been more than halved over the last 4 years, and it's been a decline of 18% year on year. So this is typically what you see when you are passing the tipping point and the fleet is having close to 90 to 100% of the new entry into the fleet are based on these new technologies. So this is typically what you have seen historically. For example, when you had the shift from coal-based steam locomotives in the United States to diesel electric locomotives in the mid 1950s, every new locomotive was diesel electric, and the decline from the consumption was 18% per year. So this is the peak decline, and that is likely to happen in the 2040s, where you will have this very rapid shift.
Yeah, interesting. And just staying on Oslo there, and I guess weaving in China as well. So firstly, new technologies, are most vehicles in Oslo now purely electric, BEVs, or are we still seeing hybrids?
No, I think it's like getting close to 60%, I think, of the fleet that is now electric. When you looked at the consumption, it was actually slightly more. It was fed by electricity rather than gasoline or diesel versus the total fleet, because basically people are driving more kilometers for their daily life, commuting back and forth to the city, than the more rare occasions they are driving long trips where they up to the mountains, etc., where they might have a preference for a gasoline car. So a slightly higher share of the fuel consumption was electric than the fleet composition.
Interesting. And then that 18% sort of rubric is quite interesting. Where is China in that journey? Are we starting to see them on a similar trajectory?
They are like 5 years behind Oslo and the big cities in Norway. So they are no more at this plateau level that they will still stay on for a few years, I think.
Okay, interesting. So the 2030 still holds. We're not sort of necessarily challenging that narrative. It's probably playing out a little bit different and to some of the early prognostications. But I guess the allied narrative to that is that, okay, so you've got peak oil in 2030. We were in a period of higher energy prices. Overall, they're still higher. But we haven't seen, the narrative is that we haven't seen the capital inflows to essentially make up the shortfall. And one of the challenges, of course, is that historically you haven't had this shelf life on oil, and therefore, you've always had capital inflows when there's been periods of higher prices, etc. But the narrative is that we haven't seen that this time round, and that we could have quite a stressed and rocky and volatile road to 2030 as the capex isn't being spent on new discovery. At the same time, you're getting a lack of investment in existing infrastructure because suddenly you've got whatever it might be 6 years to pay off an asset and so forth. So that backdrop is a challenging picture for investing in oil, and therefore we might see some oil shocks as we go into this plateau phase. Where do you sort of stand on that underinvestment in oil and a volatile decade coming up?
Yes, I think first on that overall narrative, I think that is based on an observation that in the years 2008 to 2014, investments were, close to 1 trillion in the oil and gas sector. And suddenly that dropped to almost only 60% of that, or 50% of that. And that was apparently a very big fall. But I think, and then you can have the narrative then that we are not reinvesting enough for still we are producing at the highest level ever of oil and gas, and we have a big level decline every year, so we need to still invest a lot even to stay flat. But I think that we are a little bit blind from looking at the levels around 2010 to 2014, because I think at that time it was very inefficient oil production many places globally. It was basically too inflated cost environment, and also not incentives were not there to be too efficient, for example, on the drilling side. So when we have analyzed this, we have seen that 10 years later, we are actually getting more than 2 times the production from a similar expensive well. This is particularly in shale, but we see the similar things also in offshore. That, as I said, you pay the same to drill the well, but you get on average twice as much oil from that well on the average the year after it has been drilled. So we get more oil for the same amount of cash injected. This has also been the case over the last 5 years. If you look at process equipment, if you look at the cost to build a capacity of, let's say, 50,000 barrels per day in production, the cost of that in real terms was twice as high in 2013 than it was in 2023. So looking at all of these figures together, we actually see that it has been invested enough to have the capacity to deliver on the current demand for oil and gas. And looking at 2025, we see a lot of new oil and gas coming into the market, actually more than the market can absorb. So we are not in a oil crisis over this, not last year, not this year, not the next year. We are rather on the opposite. We are actually in a very well supplied market for the next few years.
Yeah, and it does have those echoes of 2014, as you say, not in sort of the structure, but in terms of suddenly, we had new supply came onto the market and you had low prices for, the next 5-6 years. Where is that coming from? Is that particular Latin America, thinking of Argentina and Suriname and Guyana? Where is that new production coming from?
Yes, you're right. It's those regions that you mentioned. Brazil is the most important. But also from Suriname, Guyana, from the FPSOs being developed there. You also had, even this year, quite substantial growth from Norway, from Canada, and from Kazakhstan, for example. Canada has invested in new pipeline capacities, so they have evacuation now in more directions, so it's more easy for them to evacuate the oil they have. And as I said also, still you have some growth from the shale in the United States as well. Still there's potential to grow shale every year going forward. Capital discipline has limited the growth to only half of what it used to be 10 years ago. But it's still sweet spot to be drilled. Some places, even in the States, you have had some limitations for drilling due to some historical mining acreage, etc. And now, as you learn how to handle that risk, you have still some high potential large areas that can be drilled with a high productivity. So still, as I said, it's from all of these geographies has a potential to grow non-OPEC plus production, and of course OPEC has a huge potential for growth. The risk is only, of course, if they do that, it might influence the oil price in a way they don't want to see.
No, and it's, I guess, to say as well that these Brazil, Latin America, Kazakhstan, the shale potential as well, is offsetting declines that we're seeing from Russia, Mexico, and as well, right? So
that's right.
There's the potential. Were those, I guess Mexico's a different case, but were we to see some sort of rapprochement going on with Russia, probably not Iran, but that would further add to that potential oversupply.
Yeah. So yeah, but we are doing this bottom up, looking at every oil field all over the world and the investments, etc. And we actually see that it's more than enough supply globally for the next 5 to 10 years.
Does that mean that we're going to see that doesn't sound very bullish for oil prices over the next 5 to 10 years? Are we going to go back to how we essentially had mirroring what happened? This is kind of a constant refrain on the pod, sort of trying to understand whether that the 2009 to 2014 period essentially mirrors what's happened in 2019 to 2004, and that we're going to go back to a period of much lower oil prices given this investment now coming through. So we're going to see, I don't know what price it would be, but do you foresee a sustained period of lower prices in oil?
Yeah, but on the other hand, OPEC has been very successful in managing the market over the last 3 years. So despite this potential oversupply, the prices has been on a kind of acceptable level for the producing countries, and it's also been acceptable for consumers. So the oil price alone has not triggered a lot of substitution due to the oil price, that you would see if it was above 100 or $120. So in that sense, we have been in the sweet spot of the oil price that is acceptable both for the consumers and the producers. And I think we will continue to see a market that is well managed for that purpose. Of course, we can study historically the situations where OPEC has seen that their market share have been suffering and that it is not serving kind of in their interest to continue to protect the oil price if they only have to cut more every year, which was of course done in the 1980s, but it has also done in a few other situations, and in 2014, 15, 16, and also in 2020 we saw that OPEC rather took that volume approach. So if it's too much new supply that is coming in from non-OPEC plus that would price the market to take even higher market share than was anticipated, I think that could trigger an interest to use that volume weapon again. But I think that is not the most likely thing to happen. So most likely we see a plateau on production, gradually growing a little bit for the next few years and then plateauing, and managed well by OPEC, and then basically waiting for all these volumes that is now coming in to level off a little bit due to that we don't see a lot of new investments in new big fields for the next 3-4 years. So in the 2030s, with a then plateauing and declining market, again, OPEC would be a very competitive supplier for the long term.
Yeah. OPEC were obviously threatening to increase production at the end of last year. Where do we stand on that particular narrative?
I think what we have seen is that they have been postponing this increase, and I think they just want to monitor the market and see what the need will be. It's of course it's always some hesitate or some doubt to will new volumes come in from FPSOs that are ramping up, etc. So you have to monitor the market. Also, what is the demand growth globally? So of course, I think OPEC is ready to increase as soon as the market can take it. But I think it's still an open question, and of course, it's also geopolitically is quite some things happening now that could distort the market a little bit with sanctions on Canadian oil and Mexican oil and Venezuelan oil and Iranian oil and etc. So it could be some surprises that could suddenly make us or that we will see the need for OPEC to ramp up.
Yeah, because I was going to, the sort of the counter to this picture of a steady global efficient market, managed by OPEC to some extent, and all these new investments flowing through, is that we become even more fractured in a global trade environment, that Russia continues to be sanctioned, but that you have a greater disruption of global trade through tariffs, the trade war that the Trump administration is certainly pushing at. And you get a sort of a more balkanized, a less efficient, more balkanized market where certain barrels can only flow one way. The dark fleet is obviously pretty significant at the moment. Shocks or surprises to those disruptions? How likely are they? How would that influence the picture you've described of a more calmer, stable, lower price when you factor in inflation and over the last few years, oil market for the next few years?
Yes, I think it's a very interesting question and a very complicated question, and I think I wouldn't take the risk to give too much of a perspective on that because it could go in all directions in a way. So I think actually I will not be able to add a lot to that perspective just now. So sorry for that.
Yeah, yeah, I understand, right? There's a lot that could go sideways quite quickly,
Yeah.
which, perhaps, and those risks weren't really present a decade ago. It's a much more volatile world geopolitically, and, that could have some severe disruptions. Just touching back on shale, you mentioned it there that shale has a still opportunity to grow. You're gaining efficiency through now having much more sort of disciplined owners of those fields, the large oil majors and so forth, bringing a whole world of capital discipline and technology to shale. Is there anything on the shale front that could disrupt it? I mean, obviously there's earthquakes in West Texas and so forth. Is there anything there that gives you pause about that narrative?
I don't think so in terms of disrupting this completely. Like 10 years ago, it was a fear that due to environmental problems, it could kind of be whatever moratoriums or stopping shale. I remember at that time we did a municipality by municipality analysis of the conflict with the shale activity and the local community. And I think we assessed 450 different municipalities. And of those, it was only 35 that had a high conflict level. Most of them were in Oklahoma. And actually there, due to also some artificial earthquake and some surface water conflicts. But the industry has been quite clever in managing these conflicts, paying kind of the extras needed to make it environmentally acceptable, or stopped production in some regions, as I said, especially in Oklahoma. And my impression of is that it's not fundamental conflicts that will influence this, that will be a showstopper. Could influence like 3 to 4% of the production. So as I see it now, it is not going to be stopped by this. I mean, big time that will disrupt this completely.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
Okay, so moving on, there's sort of the other narrative, and again, it sort of shows how volatile the world's been over the last 5 years with pandemics and invasions and changes in interest rate regimes and so forth. We had in 2020, huge pushes towards, the energy transition became common parlance. That was tied up as well in sustainability and all those aspects. And, there was an expectation that the energy transition would be all-encompassing and immediate in some senses, at least, in the narrative. And now we're in a world where the energy transition is dead or whatever you want to say, but you've got a counter-narrative there saying it's going to be slower, take longer, and less all-encompassing than perhaps initially thought. Where do you sit on the energy transition? What does your analysis show on the speed of it and the prevalence of it?
Yeah, I think it's quite interesting narratives now that are out there. Some claim, the energy transition is dead. Also, it's a strong narrative called energy additions rather than energy transitions, and they are referring to, among others, Václav Smil. He has a book called Energy Transitions. And his observation is that new energy forms are just added to the old one and not really making them not needed anymore. with the example of coal is higher than ever, even if oil and gas and the renewables has come on the top. I think these analyses are actually failing to look at what is really happening within each segment in terms of technology transitions. Because I think what we know from technology transitions is that a new technology is coming in, and if it's cheaper and better, it's basically taking over the whole market. Like mobile telephony took over the whole market for fixed telephony. It took a while, but it's not a big growth in fixed telephony anymore. It was not an addition, it was actually a transition. And we have seen that in the media all over, and we are seeing that actually for all technologies. Look at, yes, that I mentioned, music technologies, or and I mentioned previously steam locomotives to diesel electric locomotives, etc. If the new technology is cheaper and better, it will take over everything. And this is all the economic theory from Schumpeter, etc., that is describing these cycles of disruptive new technologies coming in and creative destruction of the old technologies. And if you're studying the energy market, you are seeing actually exactly the same patterns. So for coal has been completely outcompeted in shipping, in railroads, in house heating, and in many other applications. However, not yet in electricity making and in steel production. Still, you have coal as a very core part of this. So you have to study the technologies within each of these segments. But then we see just this pattern that I just described. So if you rather do this analysis instead of looking at coal as a kind of unspecific segment, you look at each of the technologies that are using coal, you will see a similar pattern. And let me start with the electricity sector. Here, solar especially, and in the combination with batteries, are coming in as such a disruptive factor. And it has surprised everybody to go faster and to be more competitive than we have believed almost year by year. So going back to, let's say, 2008, I just looked into the International Energy Agency's report from 2008, and they said that in 2025, this year, it would be 200 terawatt hours of solar production. The cost will be $2,600 per megawatt hour, kilowatt hour in production capacity, and coal will deliver 13,000 terawatt hours. But it has ended up to be not 200 terawatt hours solar, but 2,700 hours. So 13 times as much. And coal is then not 13,000, it's 10,000. So this is just one example of how solar is replacing, we already have the evidence, even if we are just in the bottom of the S-curve of the solar. You know, solar deployment last year was probably 550 gigawatt DC. The capacities that are under development in the supply chain is 2,000 gigawatt DC. This is huge overcapacity. So supply chain is not the limiting factor anymore. It is the pace of the deployment and the finding the acreage. And then we also see some revolutionary development. For example, agrivoltaics, finding ways to combine solar and agriculture in a way that are benefiting both sectors. So it's actually not a trade-off, and then suddenly you have more than enough acreage. So this is one example. So I think still many people are underestimating the disruptive potential of solar to basically take over, at least from places where that has sufficient sun, which is basically on the level of Spain and more south. It could, in the combination with batteries, take over the electricity market, I think, within 20 years. Just like we have seen other S-curves taking over. And this, I think, is still not appreciated and understood properly. But we see it very clearly, especially in China, but also outside China, we have seen this exponential growth of solar installations.
Taking that, am I right in sort of thinking the argument is that this is a technological development that is providing more efficient, more economical sources of energy that have also fewer of these externalities attached. But to some extent, you see the energy transition effectively proceeding whether or not there is policy support around it. That might accelerate it to some extent. But in the end, we're just going through a technological revolution here, rather than one that's underpinned by policies, which are, of course, quite volatile.
Yes. First, let me then say that the energy transition is about solving 3 tasks. The first task is to decarbonize the current electricity system. The second task is then to electrify everything that is possible to electrify. And the third thing is then to get rid of the remaining about 20% of emissions through technologies like CCUS, biomolecules, and e-fuel. And the first part of this task is, as I already indicated, going faster than expected. The second task is going as expected or slightly slower. And the third task is going slower. And this is where we have seen a lot of the kind of disappointments. And because this is, as you say, very dependent on policies and subsidies, because basically these alternative molecules are at least twice as expensive as the fossil fuel-based molecules. So this is the hardest to get rid of in a way. And so overall, it's 40% of the mitigation of current emissions will be for the first task, the decarbonization. 40% will be from the electrification part, and 20% remaining 20% is for CCUS, biomass, and e-fuels, etc., and hydrogen. That is where we have seen the most kind of consolations. But it's also a sequence of these 3 tasks, because historically electricity has had the highest emission per kilowatt hour used by an end user. So you don't want to electrify, for example, functions like heating or transportation if you still have fuel that in total will give smaller emissions. So it doesn't make sense to start the electrification process too early. First, you need to decarbonize the electricity system. So that's why it's not a big problem for the energy transition that we are slower on the 2 latter tasks versus the first task, which is this decarbonization. And it will, within 1 or 2 years, we will be in a situation where it globally on average will be parity, meaning in carbon footprint, meaning that electricity will have the same carbon footprint as fuel. But very rapidly then it will have significantly lower carbon footprint than fuel. And then this is where it really makes sense from a climate perspective to decarbonize. But economically, most places already are very competitive to decarbonize the electricity sector.
Yeah. Well, it's interesting, isn't it? Because you go back to the start of the conversation about Norway, that prevalence of EVs. You already have, to your point, cheap green electrons.
Yeah.
Right, so that suddenly then it makes economic sense to have an EV, and then also you throw in the fact that EVs are, people like to drive them, they're fun drives, and so convenience and all those attributes that the customer wants. You don't have to go to a gas station.
Yeah.
Likewise, say for example, my friends back in the UK, electricity prices were high. You put solar panels on your roof, and suddenly you're getting an advantage there. A cheaper electron that then naturally pushes you down this path of getting an EV. So it's kind of what I'm saying is that actually it's a nice way of describing it. That there is a sort of series of economic incentives that drive towards decarbonisation, customer satisfaction, and so forth. And you can use that rubric to compare and contrast different countries. China has an expensive hydrocarbon electron that they don't want, that puts them in a bad geopolitical situation, all those good things, so they're driving down the renewables world at the same time as EVs. It's that last 20% that is, as you say, that is much more policy dependent on trying to abate those
Exactly.
industries that remain molecule intensive, like aviation that we started off with. So it's where, I guess it's that last 20% that we'll probably see more volatility in technologies, more volatility in policy and different approaches.
Yes.
Which brings me, I guess, to Europe, because Europe has had a rough ride in the last 4 years as it's lost cheap molecules that were coming from Russia. It's obviously and there was also this transition period where they've been putting a lot of investment into the energy transition, but had yet to start seeing really the benefits of that.
Yeah.
Now we can probably start seeing that coming through. But you know, the transition is a challenge. And for those, and you just see it where those countries that don't have access to their own molecules are more struggling than those that do, like the US, for example, with the shale revolution. Can you just give us some sense of where Europe is at, and do you see a resurgence of manufacturing, of economic power as the dividend pays off on these investments on the energy transition, or is it going to be stuck in a hard place for the next decade?
Yeah. Okay. Let me again take one step back to look at Europe then, and in Europe it's only 2 countries that are net exporters of energy. That's Norway and Russia, and they're big exporters, both of them. All the others are importing the energy they need for their consumption, and up to 80%, for example, in Greece, or typically 60 to 65%. That was not the case 50 years ago. Then many of them were self-supplied with local domestic coal. So coal was a source of energy security in Europe, but then increasingly they become dependent on importing hydrocarbons, oil and gas from other countries. Long-term, renewables is under domestic control, so renewables will be the new coal for Europe. So for the next 2 to 3 decades, they will maybe be back where they used to be, and even at a cost of that renewables to be lower than historically the cost of coal. So in that sense, the energy transition is representing both energy security and energy affordability for Europe in addition to energy sustainability. And in the electricity sector, for example, yes, for some countries like Finland, Denmark, Sweden, Portugal, Spain, and we have seen a very rapid decarbonization, and they're close to getting to a 100% non-fossil portfolio, and they have managed to do so without too high investments and too much disruptions. Some other countries are behind and need a much longer term, but in one way we have the evidence that the electricity sector is already delivering. In terms of the fuel sector, that has been declining, due to higher fuel efficiency, etc. But I know it will be declining faster due to electrification. But still, we are very dependent on that, and of course, that has the geopolitical situation and the losses of the gas from has created a lot of disruption, and it still will. But Europe has been extremely fast to adapt to a situation without Russian gas, with the LNG import, but also with a drastic reduction actually of gas over the last 3 years, much faster than anyone would believe, I think. So gas consumption has gone down. It's now expected to actually stop the decline and have some revitalization of some of the industries that has been at a very slow pace after COVID and the invasion. Probably now it's coming back, and you're trying to find new processes to manage with less natural gas, for example, in the German industrial sector, etc. But all of these molecules is more costly if they are not traditional fossil fuel. And for Europe, it's been more important now short term to just have enough molecules, regardless of the color of it, in a way. So, but Europe has had very ambitious targets for the energy transition. We see that they are lagging on these targets. They are not likely to achieve this 55% reduction, etc. So this is in one way negative news for the pace of the energy transition, that Europe is behind, but not too much behind, but they are behind. But if you take the global perspective, since China and a few other countries are moving much faster than anticipated, actually the European targets are more ambitious than they need to be for to reach a certain level of avoided global warming. So it's not necessarily still a crisis in a way for the question of global warming, that Europe is slightly behind the ambitions they were articulating a few years back.
Interesting. So I guess one question that sort of arises from that is, we also see at this period, political polarization, populism, a shift to the right. You've got that movement going on in Europe. Just suppose that Europe starts to backtrack on its climate goals, nation by nation, and the EU in particular. It's still pretty much in the same situation, right? It still needs to decarbonize because, again, they are net importers of molecules, and the largest slice of those molecules, i.e. Russia, is currently cut off from that market, irrespective of your policy, unless there's some, I don't expect to see it, but there is an end to the war and then suddenly the sanctions lift. So in some ways, irrespective of I guess, stated goals, Europe benefits from and has to decarbonize simply as a result of its energy makeup. Is that a fair assessment?
Yes. I think for Europe and especially East Asia is the two regions in the world that are net energy importer to a big extent. And they are also then the two regions that are benefiting the most from the energy transition, basically because they get more control over their own energy supply. And the cost is also acceptable for them to do that. So I think Europe will continue with this, especially to decarbonize the electricity sector. And then we are seeing CCUS, for example, which is also needed to get to net zero, has slowed down, except from in the UK, due to very strong policy support in the UK. And now it's actually a lot going on there with fast progress due to governmental support, and which is basically kind of really full pace, while the rest of Europe is struggling a little bit on that arena, for example.
No, it's been fascinating, actually, and you've given me some good frameworks to think about, some of these narratives, and obviously some of them have been reinforced, others are somewhat under challenge, and I guess it just comes back to this: if you were in normal times, the economics, the flows are quite clear, and you would see a period of probably more stable energy prices, lower energy prices as we get the energy transition dividend that continues this peak oil narrative around 2030. And essentially what I'm saying is there's a few curveballs out there that neither of us particularly want to spend an hour commenting on, because it's so uncertain and there's a lot of fragility in the world at the moment. So all being equal, there's some quite clear narratives out there, but things aren't all equal at this moment.
Yeah, but I think people tend to pay more attention to a lot of the kind of negative news that has surfaced on that is kind of against energy transition than what is actually happening on the ground in a way. And we see that even in America, we are expecting increased solar installations over the years to come, basically because it's a very strong business case to do it. So economics drive it.
Yeah. Texas leads the energy transition, right?
Yeah.
And as you say, there's a bias towards a story, there's a bias towards an event, and less of a bias towards just following the threads of the economics and the technologies. And on that point, I guess it would be great to get a couple of words on Rystad Energy and indeed where people can come find this type of analysis and what you offer.
Okay, thank you. Yeah, we are 830 people all around the world, 37 different offices, and we are working on basically describing the energy system in its greatest details, and to have all the data on all the assets, hundreds of thousands of energy assets, whether it's oil fields or gas fields or solar plants or wind farms or even turbines, and all the supply chain, etc., and to have all this information accessible for our clients all over the world, to enable them to take all kind of decisions related to strategy, acquisitions, benchmarking, all of this, and also with an advisory department that are working with all the or a lot of organizations globally to help them to basically do everything from transactions to develop new strategies, etc., to understand where to place, where if you want to have a hydrogen plant globally, where should you place that? Or if you want to acquire a renewable company, what will be the best acquisition candidates? Or if you want to acquire an oil field, where should that be done in the most value creating manner? So we are energy nerds, we are calling ourselves that, and we just want to describe this whole energy landscape in the biggest with the biggest granularity possible.
Well, fabulous. Jarand, it's been a real pleasure having you on, and I'm sure all our listeners are very familiar with you and Rystad, and hopefully we can have you back on in a year or so and see where these narratives are playing out. I think it's been great to kind of have that overview underpinned by the data.
That will be exciting, yes. Okay, thank you.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.